In today's volatile financial landscape, marked by rapid technological advancements and ever-changing market trends, a steadfast approach to investing is paramount. Value investing, a time-tested strategy championed by legendary investors like Benjamin Graham and Warren Buffett, offers a beacon of stability and long-term growth potential. Unlike speculative trading that chases fleeting trends, value investing focuses on identifying undervalued companies with solid fundamentals, poised for sustainable growth. This approach emphasizes a thorough understanding of a company's intrinsic worth, independent of short-term market fluctuations. Christopher H. Browne's The Little Book of Value Investing serves as a comprehensive guide to this enduring philosophy, distilling complex financial concepts into digestible insights for both seasoned investors and curious beginners. This essay delves into the book's key principles, simplifying them for a wider audience and illustrating their practical applications in today's dynamic market. By understanding the core tenets of value investing, individuals can empower themselves to make informed investment decisions, navigating the complexities of the financial world with confidence and foresight. At the heart of value investing lies the concept of intrinsic value, a measure of a company's true worth based on its underlying assets, earnings potential, and long-term growth prospects. Unlike market price, which fluctuates based on investor sentiment and short-term trends, intrinsic value represents a more stable and objective assessment of a company's fundamental strength. Value investors seek to identify companies whose intrinsic value significantly exceeds their current market price, recognizing these discrepancies as opportunities for potential future gains. Browne emphasizes the importance of thorough research and analysis in determining a company's intrinsic value. This involves delving into financial statements, understanding industry dynamics, and evaluating the company's competitive position within its market. By carefully assessing these factors, investors can gain a comprehensive understanding of a company's true value, independent of the often volatile fluctuations of the stock market. This analytical approach allows value investors to identify hidden gems, companies with strong fundamentals that are overlooked or undervalued by the broader market. Identifying undervalued companies requires a discerning eye and a willingness to look beyond the superficial trends that often drive market sentiment. Value investors prioritize companies with a proven track record of profitability, strong cash flow, and a sustainable competitive advantage. These factors contribute to a company's long-term growth potential, making them attractive targets for value-oriented investors. By focusing on these fundamental indicators, investors can identify companies poised for sustainable growth, even if their current market price does not reflect their true potential. One of the core tenets of value investing is the concept of a margin of safety, a principle championed by Benjamin Graham and emphasized throughout Browne's book. This principle advocates for investing in companies at a significant discount to their intrinsic value, creating a buffer against potential risks and uncertainties inherent in the market. By purchasing stocks below their true worth, investors create a cushion that protects them from potential losses, even if their initial assessment of the company's value proves to be slightly inaccurate. This margin of safety serves as a crucial safeguard against the unpredictable nature of the market. Even the most thorough analysis cannot fully account for unforeseen events, economic downturns, or changes in industry dynamics. By incorporating a margin of safety into their investment decisions, value investors create a buffer that protects their capital from these potential risks. This approach acknowledges the inherent uncertainties of the market, prioritizing capital preservation alongside the pursuit of long-term growth. The margin of safety acts as a buffer against potential errors in judgment or unforeseen circumstances. By purchasing stocks at a discount to their intrinsic value, investors create a safety net that mitigates potential losses, even if their initial assessment of the company's prospects proves to be slightly off. This approach recognizes the inherent limitations of financial forecasting, acknowledging that even the most meticulous analysis cannot fully predict the future. Incorporating a margin of safety into investment decisions requires discipline and a willingness to forego potentially higher returns in favor of a more secure approach. Value investors prioritize capital preservation, recognizing that protecting their investments from potential losses is paramount to achieving long-term success. This cautious approach allows them to weather market fluctuations and emerge from periods of uncertainty with their capital intact, ready to capitalize on new opportunities as they arise. Patience is a cornerstone of value investing. as the realization of a company's true potential often takes time. Value investors understand that the market may not immediately recognize the intrinsic value of their chosen investments, requiring them to hold their positions for extended periods, sometimes years, to reap the rewards. This long-term perspective distinguishes value investors from short-term traders, who prioritize immediate gains over sustainable growth. Browne emphasizes the importance of resisting the allure of short-term market fluctuations, urging investors to maintain a steadfast focus on the long-term prospects of their chosen companies. Value investors recognize that market sentiment can be fickle, driven by emotions and short-term trends that often deviate from fundamental realities. By maintaining a patient and disciplined approach, investors can ride out these periods of volatility, allowing the intrinsic value of their investments to manifest over time. This patient approach requires discipline and a strong belief in the underlying value of the chosen investments. Value investors must resist the temptation to react to short-term market swings, maintaining a steadfast focus on the long-term growth potential of their portfolio. This requires a certain level of emotional detachment from the daily fluctuations of the market, focusing instead on the fundamental factors that drive long-term value creation. The rewards of patience in value investing often manifest over extended periods, sometimes years or even decades. Value investors understand that the market may take time to recognize the true worth of their chosen companies, requiring them to maintain their positions through periods of volatility and uncertainty. This long-term perspective allows them to ride out market fluctuations, emerging from periods of turbulence with their capital intact and their investment thesis validated by the passage of time. If you enjoyed the video, don't forget to hit the like button and subscribe.